welcome to Market Catalyst. I'm Julie Hyman. Here is what we are watching this hour. First up, payrolls and inflation data due out this week. We'll break down what you can expect from those reports. Plus, we'll talk about the state of the AI trade and if investor enthusiasm is mirroring that of the stock market crash. Plus, we'll look at the defining moments of Elon Musk's year, from the White House to robots and beyond. We'll break down the big moments of 2025. Let's take a look at the major averages right now. We are seeing a mixed picture, little change here. Right now, the Dow just showing a few points, not even a point here of change. The S&P 500 little changed as well, and the Nasdaq composite down about 0.25%. So earlier we had been seeing indications for a higher open, but that's kind of melted away, and now we are seeing very little change for the major averages, perhaps as investors await that data to give a little bit more direction to things here. Speaking of which, if you look at what's going on in the bond market, there are a little bit more movement here, 4.15% on the 10-year, but not much change there either. What about individual stocks here? We do have some standouts to mention today. NVIDIA trading a little bit higher. Broadcom down about 3%. That's the biggest mover here of the largest tech stocks. The other one to call out here is Tesla. We'll have a few more details on this in a moment, but longtime bull Dan Ives out reiterating his bull case. That could be one of the reasons that we're seeing a little bit of a spark in that stock. And the stock, by the way, is trading. It looks like it is on track to potentially close at a record high today. We'll be watching that. It's the first time we've seen that level on a closing basis for Tesla in about a year's time. So we're going to continue to watch out for that as the day goes on. Here are the sectors in the S&P 500. Healthcare is actually doing the best today, followed by consumer discretionary. Energy and tech are the laggards today in this little changed market. The balancing act, that is what it looks like at the moment. Let's get more on that economic data now and what to expect from the big reports this week. The delayed November jobs report due out on Tuesday. Expectations there, consensus for 50,000 jobs having been added in November. The unemployment rate ticking up to 4.5%. Joining me now, Gus Fauché, PNC Financial Services Group Chief Economist, and Leslie Falconio, UBS Global Wealth Management Head of Taxable Fixed Income Strategy. Thanks to you both for being here. Gus, I want to start with you and your expectations for jobs. Obviously, the data is still a little bit lumpy now. So what are your expectations and how, not seriously, but how, are there any sort of caveats that we need to take these numbers with?
Well, the biggest caveat is that the October number is going to show a big loss of jobs. Federal government workers who took the buyout option at the beginning of 2025, they're counted as employed until their severance expires, which is going to be included in the October jobs report. So we expect to see job losses of about 85,000 total, but that's going to be coming from the federal government. We expect to see weak job growth in November, gain of about 15,000. There's no question that the job market now is a lot softer than it was in 2023 and 2024. But because of what's going on with the federal government, we have to discount somewhat the big job losses that we expect to see in October.
And Leslie, what about you in terms of what do you think the market is going to be trading on tomorrow in reaction to these numbers because of these various items of noise?
No, listen, I think, this week always has a tendency that there's a lot of data, but the liquidity might not be great. But I think the important part is the market is expecting the numbers to be weak. And the market is well aware of the fact that these are, have some clouded data due to government shutdown, due to Doge. So I actually think that you probably would back up more on a strong number than you would rally on a weak number, because I think the market is expecting the numbers to be weaker. And the market doesn't expect to have a clear indication of what the jobs picture might actually look like until, the first few months of 2026. So having this sort of, lower jobs numbers expected, the market, thinks is going to happen. And if it's stronger, then I think you're going to have a tendency to back up more in interest rates.
So, Leslie, are we in a sort of like bad news is good news environment here because of the implications for the Fed, not just of the jobs report, but of the CPI report we're getting this week?
Yeah, I mean, it's very interesting because if you look at things like 10-year Treasury yields, if you look since like the end of August, we've been stuck in a sort of a 420 range in 10-year Treasury yield most of the time for a very long time. And I do think the market is expecting, inflation to be sticky, but not as volatile. And I think that's really the key. And that's the key when you think about how sort of correlations react in the market. versus equity and fixed income. But we also do anticipate that first quarter of 26 to start to see maybe a bit of a rise on the inflation front, albeit temporary, because we do think in the second half of 26 inflation trends back down again. So I do think that the data here, I mean, we have retail sales as well, which we know is coming off a weaker control group from the last print. But I do believe that the market is going to take some of this weakness, whether it's labor or even on the inflation side, as a bit more grain of salt. I'm just going to have to wait till the first quarter to get much clearer data.
So, Gus, does that mean we need to sort of look past this week to some extent? And if so, what do you think is coming in terms of that inflation cadence and jobs cadence next year?
Yeah, I do think that we need to look through this. I mean, obviously, this data is stale, a lot of it. So it's telling us about things that have already happened in the economy. I think we need to start thinking about the December jobs report, which will come out in early January. The FOMC will have that available for their meeting at the end of January. The December inflation numbers that we'll be getting, some preliminary data on Q4 GDP, things like that. So a lot of this data is in the past. There are a lot of caveats that come with this data. And I think that as we get into 2026 and the data start to catch up, that will give us a better sense of where the economy is in early 2026. And that's what's going to be guiding the Fed when they meet at the end of January.
And what's your sense, Gus, of what the jobs picture is going to look like as we get into next year, judging from JOLTS, judging from jobless claims and some of the other data that we have gotten?
Yeah, I think that Chair Powell is right to an extent that we're in this low hire, low fire jobless market right now where layoffs remain very low, but businesses are being cautious with their hiring. The unemployment rate has moved up by about a percentage point over the past couple of years. There's a bit more slack in the job market. I think that we may see the unemployment rate move up a little bit more in early 2026. We have a job market right now that is okay. It isn't creating a lot of jobs, but we don't need to create as many jobs because labor forces growth is slower because of restrictions on immigration. But certainly the labor market is not as good as it was a year or two ago.
And Leslie, you alluded to the range that we've seen the 10-year before, which is something that has sort of caused some head scratching. We showed the graphic that you included in a recent note that we've been talking a lot about, which is that rates are not performing like they usually do when you get rate cuts. That is, they've been persistently high, even though rates have been going down. So you talked about that it could be the perception that inflation might be higher but stable. Is there anything else going on here that's a possible contender for the reason behind it?
Yeah, I mean, look, we've talked about this before quite a bit since they started cutting in September of 24. You've had this, rate cut and that back end really move higher. The term premium in that 10-year particularly has led the way. And, part of this is due to inflation as a concern. Part of this is due to deficit. Part of this is, due to what's happening, in globally with interest rates, whether it's Europe or Japan. Part of it is a supply issue, but I don't think that it really has been the main driver, particularly given most of the funding now, as the market knows, will be in the T-bill side. But I do think that there is just this bit of concern of the back end in terms of the inflation component. And I think that's going to continue. We are not of the belief that just because the Fed continues to cut, you're automatically going to have a decline in the back end of the yield curve, nor are you going to have an automatic, necessarily huge move lower in the mortgage rate. So, we are positioned more to that 3 to 5 year of the yield curve. We think the back end is, still going to have a little bit of stress. And we know next year we have some fiscal stimulus coming. We know that we know or believe, I should say, that the second half of 26, you'll see an uptick in growth, exactly how sort of like, the Fed projected in their end of 2026 GDP, which we saw, take a big jump higher. So I don't necessarily believe this is going to be a Fed that cuts and one that automatically brings that long end yields lower. So now, to the degree that they go, it was going to be something we have to see on the inflation side, right? Inflation has been very tame, and that delta, that volatility of inflation, which is really important, has been lower as well. And we think that continues. It's always about, if the first quarter inflation rises, what's the delta? What's a volatility change? Or is it something that just stays sticky or increases over a long period of time? And that has a big difference in terms of how people view fixed income as an investment, also as a hedge to the equity market.
Something else I want to bring into this discussion is the head of the next Federal Reserve, because we've seen some changing odds over the past week or so, where it seems to be more narrowed down to the two Kevins, Warsh and Hassett. We've seen that reflected in the odds-making market, for example, where Warsh's odds have gone up. Gus, does this change at all the calculus in terms of trying to, sort of figure out what the approach is going to be to rates next year?
It does. I think there was a sense that Dr. Hassett would be more in tune with what President Trump wants, that perhaps Mr. Warsh would not be as beholden to the president. I don't know if that's true or not, but certainly I think it does have some implications for Fed independence, and so I think that markets will respond to that.
Leslie, is any of that also affecting the pricing in the bond market?
Listen, I think right now, the market's not pricing in the next full cut until about June of 26. And if you come with a new chair, when you have, the Fed funds rates at the level that they are today, then they have more room to cut, right? And there's no question, if the labor market continues to deteriorate, and even if inflation stays steady, they're going to cut. I think any head of chair would want that. I think that the point comes in is where we are in terms of the Fed funds rate when the transition occurs, number one. And number two, I do believe that the market will look through candidates that maybe they believe are overly influenced politically, okay? Almost as they have when we had a number of dissents, when Myron wanted 150 basis points of cuts within 3 months. The market's going to look through that. So I think that part is important as well, but it's really going to depend on where the Fed funds rate is when the transition occurs.
Leslie, Gus, thanks so much. Appreciate it.
Thank you.
Much more markets action coming up. You're watching Market Catalysts. U.S. stocks are trading near record highs, with the S&P 500 now looking to post double-digit gains for a third consecutive year. Of course, big bets on artificial intelligence. They've been helping drive the momentum in equities. But amid the bull market, we are seeing the rise of some riskier trades. For example, we've seen investors get burned this year trading leveraged single-stock ETFs tied to Strategy, formerly known as MicroStrategy, which came under pressure because of the massive crypto sell-off. So let's talk more about the rise of risk, perhaps, in the market. Joining us now, Ross Sorkin, New York Times columnist and author of 1929, Inside the Greatest Crash in Wall Street History and How It Shattered a Nation. And Andrew, I bring up what's been going on recently because you've been drawing that parallel in many of your discussions about the book. So, what do you think? Do you think really that we are at risk of a crash like that? Do you think it's because of sort of financial engineering and innovations that are getting people to take bigger risks in the market?
So yes and no, and I don't think that it's preordained that we have to have a crash, or that we have to have a crash akin to what happened in 1929, which actually in many ways I hope was an historical aberration and wasn't just a crash, but a series of policy choices that ultimately led to the Great Depression and 25% unemployment. So even if you think we're in a bubble today that can and probably will at some point pop, it doesn't mean that the outcome has to be that severe. I do think, though, that right now we're in a moment, and I don't know if forget about 1929, maybe we're in 1996, 97, something on that order, where you see some indiscriminate spending in terms of artificial intelligence. You see a concentration in a certain part of the marketplace, and then you see a lot of new products. You talked about what Strategy, and Strategy is a new product of sorts, but I think we're going to see a lot more private credit, private equity, venture capital investment in the retail space, tokenizing things. I think anytime you have that kind of thing happening in the marketplace, oftentimes without the disclosure and transparency that you want, it can create problems. So I would not be surprised if we have some form of a problem, but again, I don't necessarily think it has to be in the 1929 category.
I mean, I was struck, though, reading your book, that there are some parallels. You have obviously a big gulf between the rich and lower income folks, and increasingly the stock market's seen as a lottery ticket or a way to catch up in some ways. In that, the 20s, to your point, regulators didn't step in until way too late to try to prevent some of that behavior. Like, what's the regulatory backdrop now Because it doesn't seem like there are a lot of curbs,
Right.
maybe more than then, but not a lot of curbs.
So I'll give you the differences and then the similarities. The differences are, back in 1929, there was no SEC, so insider trading was legal. There was no FDIC, so you did not have insured deposits. That's why we had runs on banks the way we did. We didn't have capital requirements at the banks unto themselves, something that came in 1940, really, in that Bank Act. So there are differences, important differences. I would say the big distinction today is that actually a lot of the guardrails that were put on maybe even in the 30s and beyond that, to some degree are being taken off as we start talking about putting private assets in the public marketplace, whether they get wrapped up as these things called semi-liquid instruments, which you're seeing, or this idea of tokenizing private investments, all, by the way, under the guise of democratizing finance, which was the phrase of the day in the 1920s. I think that's where you have to start to worry and look. And then there are the disclosure issues around just how transparent any of these things are. Every financial crisis, at least that I've now tracked, really is a function of leverage in the system. And the question today is, how much leverage is there really? When you look at AI, it's not just the tech companies, some of which obviously have huge balance sheets. They're leveraging a blue owl, Meta's leveraging a blue owl, private credit. Others are going outside the sort of normal system. And I think we don't know where all the leverage lies. The energy sector that's supporting this, the real estate sector that's supporting this. Where is all of that leverage? And that's a big, big issue to think about. And then one last piece on leverage, which is it's not just corporate debt. Back in 1929, there was a budget surplus. So the thing I always worry about is if we do get into a crisis, the answer that we've learned from 29, from 2008, from the pandemic is throw money at the problem, spend money, because you don't want to have austerity. That has been the right answer. But do we hit some kind of red line breaking point in terms of our government debt, at which point the bond market says we're not doing this anymore, and then what happens?
Yeah, I mean, that's something that we've kind of has been the specter for many, many years, but it hasn't quite,
Right.
It's never quite happened. Okay, so let's talk about 2026 for a moment then. So of these various things that may come home to roost, what are you watching most closely? What do you think is highest risk? How does the AI situation play out?
So I think the highest risk is just the beta between the spending on AI and whether some of these companies, in particular probably an OpenAI or an Anthropic or some of the larger players who are making relatively extraordinary commitments, whether the numbers really ultimately match, whether, right now they don't really have the revenues to support the kinds of commitments they're making. And I think we need to watch not just them, but even some of the big hyperscalers to see what kind of sales they're going to be getting. So on Microsoft, for example, when you look at Copilot, is Copilot going to be as successful as they want it to be? I think we need to keep an eye on that. I think we need to keep an eye on what's happening at Google with Gemini, but not just with Gemini itself, but also with some of the products that are going to be sold into the enterprise, and whether that spending is going to continue apace, whether corporations are going to think that this is super valuable to them, not just for folks picking up the phone to do consumer support and stuff and letting AI do that, but more to make people more productive in their regular jobs and whether that's going to ultimately take jobs out. And then one last piece, you think about AI and we keep saying, is it a bubble? Is it going to burst? What's going to happen? What about in success? Because in success, it also probably is going to have a huge impact on jobs on the other end. So this is one of those potentially double-edged swords. So we're going to have to see.
And Andrew, it's funny because Yahoo Finance, we name a company of the year every year, and this year
Yes.
it was OpenAI, a private company for the first time. And you're well aware, of course, of the debate around circularity, and that it is the fulcrum of a lot of the AI investment. Do you think that with Gemini and some of the other models sort of jockeying for position there, that's become less true? It doesn't feel less true.
No, look, I think the circularity is important to the financing these businesses. I wonder what the long-term moat is on any of the large language models, or whether they ultimately get commoditized. I think that's actually a real issue. I do give great credit to Sam Altman in terms of just capturing the consumer market. I do think, at least for now, the idea of persistent memory. I'm a ChatGPT user. The idea that it knows me and knows me a little bit better than most of the other services right now could be a lock-in effect to some degree. I don't know how many people are going to go jump from one to the other and back to the other and how that's going to work. But I think my concern is to the degree that you ultimately think that Gemini and ChatGPT and Anthropic, if they all ultimately converge to be nearly the same thing, then what?
It's a good question. And it's one that we talk about a lot, and I'm sure we'll continue to do so. Andrew, thanks so much for joining me. I appreciate it.
Hey, thank you so much for having me.
Take care. We got much more markets action coming up. Stay tuned. You're watching Market Catalysts. Now time for some of today's trending tickers. We are watching Nvidia, Tesla, and Zillow. First up, Nvidia, the tech giant unveiling a new family of open source AI models that it says will be faster, cheaper, and smarter than its previous offerings, as open source offerings from Chinese AI labs multiply. Now, of course, Nvidia is primarily known for providing chips that companies like OpenAI use to train their closed source models and charge money for them, but it also offers a slew of its own models for everything from physics simulations to self-driving vehicles as open source software that can be used by researchers or by other companies. Next is Tesla. The stock moving higher, reached its highest price this year, fueled by an upbeat outlook from Dan Ives at Wedbush. It's actually set to close at a record today, I believe. He sees a strong year ahead for the EV giant, driven by autonomous vehicles and robotics, with large-scale cybercab production expected by April or May 2026. He also noted the company may accelerate key AI initiatives now that some federal regulatory hurdles around full self-driving has eased. And finally, Zillow, shares trading lower on news that Google's testing a new real estate advertising format that could potentially compete with Zillow's services. Google's format provides comprehensive property details, options to request home tours, and displays similar listings directly within search results. It allows users to schedule home showings with top-rated local agents through a request a tour button with an expected response time of 15 minutes. Goldman Sachs noted that while the immediate impact on Zillow may be limited, the development represents a potential longer-term risk. Let's talk more about Tesla now, because 2025 has been a year of bumps and sharp turns for Tesla, not to mention the controversial $1 trillion pay package for CEO Elon Musk. Here to discuss what the 2025 experience for Musk and Tesla potentially means for next year, Ross Sorkin, Yahoo Finance senior autos reporter. Good to see you, Ross.
How you doing?
So it's been a year for Tesla,
yes.
Definitely. So let's go through it and talk about some of the highlights and lowlights. And I guess we start with something that was maybe a highlight that also was a lowlight, which is the relationship between President Trump and Elon Musk.
Yeah, each of these different story points, like they have highs and lows individually, right? So let's talk about this. So the big bet on Trump, right? Musk, the bromance in the Beltway, right? So it all started out great, right? Musk, 100 million plus funding for Trump's campaign. Trump wins the election. Musk gets unprecedented access to the White House, West Wing access, meetings with high-level officials and even heads of state. He gets essentially to run Doge, right? That all happened this year. We forget how things have changed, right? And really, they unraveled in multiple ways, but one of the biggest ways they unraveled was Trump's big budget bill. Musk was privately grousing about the fact that EV tax credit went away. There was the kerfuffle with the NASA administrator, right, that Musk wanted, Jared Isaacman, that Musk wanted installed. That sort of had a little hiccup there. Mm-hmm. And then there was a big falling out, right? A big verbal, out in the open falling out. We have a little bit of a detente now. The question is, how long does that last? But yeah, that was a big part of the year for Tesla. The stock sort of rode that wave up and down, and now we're seeing it back to the upswing, but not because of the fact that the bromance is sort of maybe over.
No, although we definitely know that it also hurt the sales of the vehicle. So doesn't hurt that it's sort of quieter now than it was. Secondly, the $1 trillion pay package, a victory for Musk in that sense.
Yeah, I mean, stop me if you heard this already, because we did the same thing last year where he had a pay package that he got approved, got challenged. I'm assuming we'll see this one get challenged again, but it'll be easier because they incorporate in the state of Texas, and it's a little bit easier to get these things through. But yeah, $1 trillion pay package, approved by shareholders, not without some controversy. We had some big, large funds upset about it, but it still passed. And some aggressive goals that Musk needs to hit next year over the next few years: EBITDA goals, robo-taxis, like we mentioned, robots as well. The thing is, Musk gets a little wiggle room there. The board has some leeway to award him some money if he doesn't meet these goals. And the question is, how independent is the board anyway? But that's another discussion for another day.
That is another discussion. All right, you alluded to the robo-taxi, and indeed, we saw some milestones for that after characteristic sort of Musk delays and exaggerations. But it's real now. It's happening. It's on the road, and in some cases, it's better than ever, according to some recent talk about it.
Right. I mean, look, this has been a dream of his for a long time, and finally, I think it all started last October when we saw the Cybercab reveal, and then the question is, so there's an actual purpose-built robotaxi coming out. Then they began the testing of the robotaxi service in Austin, and it's been expanding. And this new safety data came out that showed it was relatively safe, but not as safe as Waymo in terms of incidents, but still decent enough. And they're expanding that. And then we saw last night, apparently, this is Sunday night, apparently some taxis were out there without the safety driver. So the question is, did they get approval for that? How are they testing that? Is that next? People who have been driving FSD have seen the most recent example, very strong, very smooth actual driving, and it's working. The question is, can they keep expanding robotaxis, right, to other areas? And then also, will people trust it? Will you want to drive in one? I think that's the big question. Remember Cruise, right? They were doing great. Then a high-profile accident in San Francisco with a pedestrian, and it was over. So the question is, can they survive this? This is going to happen. There's going to be a high-profile accident. The question is, can they overcome that?
Well, of course, a Waymo ran over a beloved neighborhood cat in San Francisco, and it's still, and it's gotten some recent press, but it's still going. So we'll see, how all of these things develop. Okay, so that's all 2025. 2026, more robotaxi.
Right.
Optimus news, maybe. SpaceX news, maybe. XAI news. So in other words, it's going to be another busy year for Elon Musk.
And you mentioned at the top earlier in your trending tickers, Cybercab production, right? Is that really going to happen in the first half next year? I think that's a big thing to watch. Optimus Robots too, they claim that that's going to go beyond pilot production. We'll see about that. XAI, they've already introduced Grok into the car, and people are starting to like it. We'll see. But I think that big thing is that Cybercab for the auto business, right? Is that going to happen on time?
Right. Well, of course, but it's not a car company, so it doesn't matter.
Oh, right. Sorry. Yeah.
Pross, thanks so much. Appreciate it. Coming up, Taylor Swift's The End of an Era docuseries is out now. How the pop star continues to affect the economy even when she's not on tour. That's next on Market Catalyst. Taylor Swift is out with a new docuseries chronicling her historic Eras tour. The series on Disney Plus goes behind the scenes of the tour that left quite the imprint on the U.S. economy. The Eras tour saw fans spend $1,300 on average and resulted in a total economic impact likely exceeding $10 billion, according to the U.S. Travel Association. Yahoo Finance's Jared Blickray spoke to Misty Hegenes, economist and author of Swiftonomics, about the pop star's influence.
Talk to us about how special Taylor Swift is, because we've seen big names before, from Michael Jackson to Rolling Stones, Beyonce, but by the end of 2023, we're talking about Swift's contribution to global GDP. I've just never seen anything like it.
Yeah, I mean, she is just on fire. After the Eras tour, I think it was over 10 million people who actually attended the Eras tour and saw her in concert, over $2 billion in earnings from the tour. And, it was just such a delight for so many people to see her out there and perform. And if you watch the docuseries, which I woke up at 2 a.m. to watch it, she talked a lot about her dedication to the craft and to her fans, and making sure that this was something that people would leave the stadium just feeling like they'd been a part of something really big.
Well, I think that's key. I mean, engagement is the mantra of social media and kind of the new media paradigm here. Talk to us about Taylor Swift, maybe as part of a larger trend here that resonates with some of the younger generations. What changes has she instilled in the industry? What we've seen maybe carry over to some other artists?
Yeah, so I think she's just been such a trendsetter, and she's really a masterclass in female leadership. Again, you can see that resonate through the first 2 episodes of the docuseries. She has really grown up in an industry that was never really built for people like her keeping in mind people like her. So it's an industry that's heavily dominated by male leaders. And, I think Taylor has shown us a lot of the ways in which she has struggled to be successful, struggled to retain ownership of her art. And yet she came out at the end of all of this very successful. And so I think one thing that she is teaching the next generation and young folks today is just, determination and authenticity can get you pretty far away in the path that you are choosing for yourself and the direction you want to go.
Yeah, I'm glad you highlighted her contribution as a leader. Talk to us about some of the cottage industries that have grown up around Taylor Swift, her leaving Easter eggs for her fans all the time, just friendship bracelets, for instance, that became so popular over the concert series. What are some of these businesses that have just popped up around her?
Yeah, so there's a lot of small businesses. I mean, you can go on Etsy and just find unlimited amounts of Taylor merch from, small business entrepreneurs who are Taylor Swift fans and just trying to support their community and each other. And, there's stories about craft stores running out of beads along the Eras tour. So there's a lot of really, like you said, cottage-based industries. Taylor also wears a lot of clothing that comes from female small business owners. The sparkle stickers on the cheeks, that was a big deal. So, it's really fun to see not only Taylor being so successful and really having this meaningful relationship with her fans. She's also extending that economic growth and people's willingness to spend money on other female entrepreneurs around the country. And it's just really fun to watch.
Yeah, and talk to us about, it's not just small businesses that she has promoted. We've seen some big names also benefit from the Swift effect or Swiftonomics. Ralph Lauren, Cartier. Talk to us about some of those bigger deals or bigger influencers.
Yeah, I mean, the one thing that Taylor has going for her, I think, is, she has so strongly connected with her fans in such a way that they will move mountains for her. And so if you are a big business, or a medium-sized business, it is to your advantage to try to figure out how to get into the environment and the lore of Taylor Swift, because it's, pretty much guaranteed that that will rain down positiveness on you, whether it's through additional dollars, or whatever it might be. And so, I think some of these big businesses, they, have a relationship established with Taylor, and they recognize not only that it's an honor to be working with her and maybe, producing costumes for her shows or whatever it might be, but they also realize that has ripple effects because she has such a strong following in the community.
And I was just looking at your website here. It looks like there's fewer than 50 days to go to get the book. Tell us about the process. What did you learn? What surprised you as you were researching and writing this book?
Yeah, so one of the things that surprised me when I started this book, I wanted to write a book about women in the economy. And I had been following Taylor for a while, and I just felt like she was such an awesome example of how women can thrive even against the odds. And so I started really digging into Taylor and her music, and it's like peeling back the layers of an onion, but it's not an onion. It's like something sweet that you really, it's not going to make you cry. You're really gonna, yeah. And, so it's just following the storylines of the women that Taylor writes about in her lyrics and in her songs has really been fun. You can think of Clara Bow, Idina Sackville, Rebecca Harkness, Elizabeth Taylor, really leaning in and finding out the stories of all these women who have many similarities to Taylor. So I think that's been a really fun adventure. And then, just understanding how Taylor fits into the larger storyline of the U.S. and women as economic agents and women in the economy.
And we got about 30 seconds here. Any final words to the viewers or Taylor Swift herself?
I just, watch the docuseries. It's a really fun masterclass in excellent accelerated female leadership. And, there's a lot of young women out there who could learn a lot from Taylor in terms of leadership and how to be authentic in order to thrive in your craft.
All right. Misty, thank you so much, and really looking forward to that book.
Thank you.
Coming up, President Trump is expected to sign an executive order to reschedule marijuana. We're discussing with the CEO of a cannabis company next. Shares of Tilray Brands jumped over 40% on Friday, though it's giving back some of those gains today. The pop coming after reports that President Trump is expected to reclassify marijuana as a Schedule III drug that would lessen some federal restrictions on cannabis companies. Tilray has a mix of consumer brands that include medical cannabis, recreational cannabis, and alcohol and spirits. And Irwin Simon, Tilray Brands chairman and CEO, is joining me now to talk about all this. Irwin, it's good to see you. We've talked about this a little bit before. So if there is this rescheduling, remind us, what effect would it have on your business, especially since you guys are domiciled in Canada? So how does that work?
So first of all, good morning, Julie. How are you? Happy holidays. Number one, we're a U.S. domiciled company, so that's okay. Number one. So if you come back and look at Tilray today, if you look at our Canadian operations and our international operations, which I just came back from Europe, we have a $150 million medical business today. So we're well entrenched into medical cannabis. And with the rescheduling, what it does for Tilray, it allows us to get into the U.S. business. It allows us to take what we've been doing both in Canada and Europe, and all our studies, our research, our clinical studies, our different strains, and come here. And with that, working either with the FDA, working with hospitals, working with our doctor groups, we can help a lot of patients in regards to what we can do with cannabis. So we're not going to be in the recreational cannabis business. We're not going to be selling cannabis through stores. What our business would be is taking everything that we've done in Europe and Canada and transporting it here. Also, the big thing, Julie, we have over 6 million square feet of grow of cannabis between Canada and Europe, and hopefully us taking the strains, the genetics that we use in Canada and Europe and bringing that to the US to help patients that need cannabis, whether it's for cancer patients, whether it's for epilepsy, whether it's for stress, for sleep. So it is a big thing for Tilray. The other big thing is this here. We don't have the legacy of taxes which other MSO has. We don't have any of that. So it doesn't legalize cannabis, but it will be big for patients that need cannabis for a lot of medical reasons.
And forgive my confusion, Irwin, it's because you don't grow the cannabis in the United States. It's in Canada and Europe, as you alluded to. So in order for you to sell recreational, that would require a lifting of the federal ban, correct? But so if it was the medical portion of your business, how significant a business opportunity is that if this change actually does happen?
So we estimate about $10 billion of medical cannabis could be sold in the U.S. So if, we had a 10% share, that's $1 billion. We get a 3% share of that, it's a $300 million business. So it gets us access to the U.S. market to sell cannabis and utilize the assets that we have with our grow and knowledge. And it's incredible. I just came back from Europe, and the demand right now is outstripping the supply because of patients wanting cannabis for so many different uses. So I think this would be great because I come back and look at it from the opportunities for medicine and what it will do with medical cannabis and what it will do to help patients. And I think it's just tremendous. And, we have a real good plan in place of what we would do if this happened and how we would ultimately do it.
Well, and I was going to ask you about that also, Irwin, because we've had some fits and starts, right, with this before, where reportedly we were getting close to the rescheduling, didn't quite happen. This seems like it's closer this time. So, how quickly can you turn on that supply into that medical cannabis market in the U.S.?
Julie, as I said before, we've been doing this now for the last 6 or 7 years. Yeah. We can really turn it on pretty quickly. I've been having meetings with our teams, over the last few weeks. And again, taking what we've done in Europe, taking what we've done in Canada, and actually, transporting it here is something very easy. And today we ship, multiple tons of product to Europe out of our Canadian facilities. We grow multiple, grams of cannabis in our Portugal facility. So we have the know-how to do it. We have the doctors, and we've done clinicals in Europe, and hopefully the FDA will accept some of those clinicals that we can use these products here.
I want to ask you about something else on the regulatory front, Irwin, because apparently in the bill that ended the government shutdown, there was a measure related to hemp and sort of products, including beverages, that include THC derived from hemp. And I don't know what your derivation process is for your beverages, but it's something that would propose banning that kind of production. And I just wonder what the effect, if any, that would have on the business.
So number one, in Canada today, we have close to a $50 million business that sells cannabis drinks, and they're only sold within cannabis stores. And we think that, the different provinces are working on things that will allow us to sell these, whether it's in beer stores or within liquor control businesses. So we see a big opportunity here. In the US, there was a loophole, and it was a loophole that you could sell cannabis drinks with anywhere from 5 to 10 to 15 milligrams of hemp THC products, and you could sell them in those states. There was a bill introduced as part of opening up the government. I don't think anybody wanted to stop that bill. And Senator O'Connell, I think probably got some pressure from, a lot of, whether it's the spirits companies and not to stop this. But I think what's happening today, and from everything I understand, there's bills being introduced. And what the good thing is here, whether it's the new cannabis bill that President Trump, will sign into effect in regards to rescheduling, whether it's the bill that will come into effect, which Senator Wyden is introducing in regards to hemp, I've always called for regulation. And that's what's important here. There's regulation that will come into place. And I think they'll regulate whether it's 5 milligrams of hemp in regards to drinks or 10 milligrams, because you got some rogue companies out there selling hemp today with 50 milligrams, which shouldn't be being sold. And it's the same thing with medical cannabis. You got, some illicit markets and markets out there selling cannabis as medical cannabis that does not have the different strains out there, does not have the genetics to be used for that. So what's important, what President Trump's doing, is bringing regulation into this and from a rescheduling. And it helps eliminate an illicit market. It helps put in place real regulations and really quality control, whether it's hemp drinks or it's medical cannabis. And I think that's important. One thing we can say about Canada, even though I don't like the excise tax there, the Canadian government really put in place some great processes and policies in regards to both recreational and medical cannabis in Canada. And that's the same thing we're seeing in Europe. As I come back, Germany has, developed one of the biggest markets today in regards to medical cannabis there. So from a standpoint there, if we can do this in the U.S., and we should be doing this in the U.S., not looking just at recreational cannabis, but looking at the medical benefits that cannabis can give to patients.
It seems like perhaps we're heading in that direction. Irwin, we got to leave it there. Thank you so much for joining us. It's great to see you as always. Thanks.
Thank you very much for having me.
We will be right back in the second hour of Market Catalysts. Into the start of U.S. trading. I'm Julie Hyman. Let's get a check of the markets. Taking a look at the major averages, all three trading slightly lower, with the Nasdaq leading declines, off by about 1/3%. But let's talk about the year now, because the Dow is up more than 13% this year, but not all of the stocks in the index have had a strong year, of course. We're taking a look at the 5 worst performing Dow members in 2025. They include United Health, Salesforce, Nike, Procter & Gamble, and Honeywell. Markets and data editor Jared Blickery here now with a closer look at their performance in a series that we are calling Down Bad.
I get it. Thank you, Julie. And yes, even in a good year, somebody's still getting coal in their stockings. And we've got 8 Dow components in the red this year with a familiar list of reasons. We got healthcare bills, shopper mood, and even a little AI hype check. And today we are tackling the bottom 5. So let's pull up our Dow here. And this is going to be the year-to-date performance. I'm going to sort by best to worst. And now let's just start with United Health. This is a big one, and it is down 30% this year, 33% as you can see. Now, United got hit by a medical cost wake-up call. Management talked about costs running hot, and that turned into guidance drama and headlines about leadership change that investors did not love. And you can see the big post-Liberation Day drop there, which it hasn't recovered from. And this stock has now been down 3 straight years. But by late October, United said turnaround efforts were getting traction, raised its 2025 profit forecast. Nevertheless, costs remain elevated, and the big technical hurdles overhead are the $380 and the $440 price levels. This one isn't a meme stock meltdown. It is a core household name stock getting hit by the least fun surprise in America, the bill. And next up, we have Salesforce. This is down about 24%, which is basically paying the AI tax in reverse. Investors keep asking where the AI payoff is. And recently, the message has felt more like wait and see than show me the money. Like United, this stock has been stuck sideways since those April lows. So even if it does pop on earnings here or there, the big question is whether AI turns into real paid demand or just nice features that get bundled and discounted. Salesforce brought the gift, and investors are now asking if anyone is actually unwrapping it. Next up, we have Procter & Gamble, which is down about 14%. Now, PG is the consumer mood ring, and lately the signal has been a little more nervous, with company commentary pointing to a choppier shopper backdrop. And you can see in this chart that the stock has just bled lower all year long, printing a 2.5-year low just a couple weeks ago. This is a kind of stock that doesn't need a recession to slip. It just needs people to trade down, wait for promos, or to buy one less thing per trip. And PG is usually a quiet stocking stuffer that you can count on. But this year it's more like socks that don't quite fit, somewhat useful, but not exciting. And then there is Nike, down about 11%, which is a good example of a turnaround stock that's taking longer than the market's patience. Inventory, discounts, and a channel reset have kept the story heavy, and the tape tells you the same thing. Nike has now been down 4 straight years, and earlier this year at the lows, it was down 70% from its 2021 all-time high. So investors want proof, not promises. But Nike is still Nike, and this stock just happened to spend 2025 running on a treadmill. Finally, there is Honeywell, down about 8-9%, which is a story of big change and bad timing. It's been floating a breakup plan that would unlock value through 3 separate companies. But this year, you also had a softer energy outlook that made the market say, okay, but when? Now, this stock has been stuck in a 5-year trading range and happens to be in the middle of it right now. So Honeywell is a stock in need of a catalyst in 2026. For 2025, Honeywell offered 3 gifts instead of 1, and investors asked for the receipt, thinking of a possible return. And you might be wondering about the prospects for a 2026 turnaround. So before I go, let's take a look at how 2024's dogs did this year. And I'll get that up here. And here we have them. Now, 2 of them, Intel and Dow Inc., were doing so badly that in November of 24, they were replaced with NVIDIA and Sherwin-Williams, respectively. Intel managed to turn a 60% drop into a near 90% gain return this year, but Dow doubled down and its losses added up to 40%. And that's after last year's near 30% slide. And then after a 30% slide of its own in 2024, Boeing clawed back 15% as Nike's 30% fall was followed by an 11% drop. And finally, Amgen's 10% 2024 slip was met with a 22% gain so far this year. So all in all, it is a mixed bag with last year's laggards. Bottom line, the 2025 losers aren't broken companies. They're blue chips with specific 2025 problems. And the fun part for investors is what comes next. Which of these gets a New Year reset, and which ones are still wearing the same sweater in January?
Jared, it's the question indeed, and it's a question we're going to be digging into for each of these companies all week. Thank you so much. Well, as we talked about, Nike is one of the 5 worst performing stocks in the Dow Jones Industrial Average this year, and we're taking a closer look at the stock and the company as part of our Down Bad series. Joining me now, Anisha Sherman, Bernstein senior analyst. Anisha, it's great to see you. Now, I know that you have some optimism when it comes to Nike, and really, as we just talked about, the setup there is people sort of waiting on this turnaround to bear fruit. So I guess, first of all, I'd ask you where they are in that process, and then we can get into like what needs to happen next year for the stock to come back.
Sure, Julie. So Nike got a new CEO about a year ago, and his first course of action was to clear a lot of old, stale product. And that resulted in numbers getting cut towards the beginning of this year, which drove a further correction beyond last year's already down 30%. In the last 6 months, though, the tone has sounded a lot more positive. They've cleared most of their old products. The new product that's out in the market is working. Actually, a lot of the new running product is selling through well. The new Vomeras are actually sold out, I think, ahead of the holidays. And they are regaining market share with retailers. So we are reaching the tail end of this big correction in performance and in inventory. And some of the new stuff is really resonating. So it does sound like they are turning a corner. That said, as your correspondent just said, the market doesn't have a lot of patience with turnaround stories right now and tends to be risk averse at the moment, especially on consumer discretionary names. So the stock is still not being given credit for some of the changes they're making, which I think should start to turn around into the new year.
Okay, and so what do investors really need to hear concretely from Nike to maybe change that perception as we get into next year? And by the way, the company's about to report earnings too, so we might get a little bit of clarity on that front.
Yes, so the biggest thing is top line growth. After several quarters of negative growth, Nike posted flat growth last quarter, which was much better than expectations. They have cautioned that this is not going to be a linear process. They've now guided again for a slightly negative growth this quarter, but that is the biggest indicator. Once they can start getting the top line turned around, that also helps margins, it helps operating leverage, it helps the entire earnings growth algo inflect. And that's the biggest thing people are looking for evidence of, is they can start to grow again and gain share again and resonate with consumers again.
And you talk about in your latest note about Nike that lifestyle is sort of the missing piece, that like in running they're doing better, in sort of performance they're doing better, but lifestyle. And maybe, I don't know if there are also some sort of cultural shifts that have gone away from the athleisure type look that Nike's presenting, or is it more product based that they need to come out with more appealing stuff?
It's a bit of both. So lifestyle was dominated by their Jordan franchise, which is part of what they were trying to clear over the last year. So when you're clearing old Jordans, it's really hard to generate brand heat on that same franchise at the same time. So they need to take a beat, sit out this year, and then rebuild their lifestyle portfolio led by Jordan, probably in a year or a year and a half from now. But in the meantime, they're losing share. And you alluded to cultural shifts. We've all seen that meme of people switching out Nike Tech for quarter zips. And that doesn't help them either. If people are switching out their look, going for a more preppier look, that doesn't resonate with the brand. That's another blow to the lifestyle portfolio over the next few months.
I guess we'll have to wait for them to come out with their own quarter zip, which brings me to another story I want to talk to you about. And this is one of the worst performing stocks in the S&P 500 this year. I'm talking about Lululemon, which has also really just struggled this year, hasn't been able to gain traction, just said that its CEO was stepping down. Is that what needed to happen for Lulu to turn around? What do you think its prospects are like for 2026?
I think Lulu is in a tough position right now. It is a market leader in the sportswear apparel market, which is a competitive and fragmented market. And there are lots of new brands popping up over the last couple of years with the help of social media and kind of ankle biters that are gaining traction and gaining consumer market share. And Lulu needs to stay relevant. And it's hard to do that when you are the market leader, the incumbent with the majority of market share. And that's what they need to deal with at the moment. The CEO change was a positive catalyst. The stock was up. The market was expecting that, perhaps not as soon as it came out. But I think it's the first in several steps they need to take to regain investor confidence and to grow again in the U.S., which they haven't done now for over a year.
I mean, they sell a quarter zip. Do you expect that to be a big winner for the holidays?
I do, actually. I think that will be a nice boost to their sales this holiday, but it's a more widespread problem where their entire U.S. business has been shrinking for several quarters. So I don't know if one trend is going to do it.
Yeah, it's not like the bag that can be sort of the hero product necessarily for Lululemon. But that also brings me to another note that you came out with recently that obviously you guys had a lot of fun with. I had a lot of fun reading it. It is your top fitness products for going into next year that also sort of doubles as a potential gift list for people. That Lululemon quarter zip is on there. It's a pretty diverse list, actually. One of the other things that I know you're into that's on there is a sleep mask that sort of makes you look like a bug, I guess is called Manta, right? I guess that's why it's called Manta, I assume.
Yeah, there's a lot of interesting products out there, which are good stocking stuffers and also some bigger purchases, as well as just good lists. Fitness is the most popular New Year's resolution category. And so it's also an area that gets a lot of spending in early January as people are looking at their health and fitness goals. So the sleep mask was an interesting one. It doesn't press down on your eyes. It has lots of little bells and whistles with Bluetooth and with white noise that you can connect to. And so for people that travel a lot, especially on work, and are trying to get a better year of sleep in 26, that's one of the things we would recommend.
And speaking about shoes, also, you do have a Nike on the list, but one of the tops on the list is a new On running shoe that looks sort of like futuristic. And I guess that also speaks to, this has really been On's year in some ways. And so the inclusion on the list also doubles as kind of the recognition that they've been outperforming.
Yeah, I think this is my best idea in terms of a long-term compounder in global sportswear. It has low market share in every market, a premium product, no discounting or clearance issues, a strong management team, and exposure to several categories. So I really like the stock, but I also like the shoes. So these shoes are using their new light spray technology, which is effectively, if you think about a shoe being spun together by a robotic arm, it can happen in 3 minutes. You can look these videos up on YouTube, and they're now trying to scale this to be a scalable commercial running shoe. It looks very futuristic, no shoelaces, really cool look. So yeah, I think that will be a strong one that's coming out through in 2026 and should be scaling up. You should see it in your stores soon.
And I misspoke. On has not outperformed this year. The stock is down this year, so maybe that'll help it recover a bit going into next year. And then just one other product that you like here, a tote bag that I know you guys put on the list also. How do you guys go about even picking it? Do you sort of like crowdsource it amongst the team? How do you go about putting this together?
We crowdsource it. I will say one thing on. The company has outperformed. They've raised guidance 3 times this year, and their numbers are up, and they've been outperforming. The stock has suffered from a pullback from consumer discretionary and a rotation, which is also a reason why I like the stock into next year, because it's not driven by fundamentals. It's driven by more market sentiment. Gotcha. But yeah, the bag, I like it. It's a good weekender bag. It's a good crowdsourced item that we heard from several people they're using. Also good for business travel as well as for leisure weekends away.
I'm sure you're doing. I hope you're doing lots of the latter as well as not too much of the former, Anisha, in the coming year. Thank you so much. Great to see you.
Thanks.
Coming up, EY is out with its 2026 Geostrategy outlook. We'll look ahead to the new year through the lens of tariffs, scarce resources, and AI. Stay tuned. You're watching Market Catalysts. While President Trump has lifted some tariffs on items like coffee, oranges, and cocoa, they are expected to add to geopolitical uncertainty once again in 2026. That's just one point highlighted in EY's 2026 Geostrategy outlook. For more, I'm joined by Courtney Rickard McCaffrey, EY Global Geostrategy Insights leader. Thanks so much for being here. So, as we look at the sort of geostrategy and where it intersects with markets and economic uncertainty, tariffs is probably pretty high up on the list, Courtney. But this year, it was really difficult to predict where they were going to go next. So how do you try and figure that out for next year?
Yeah, it's a great question. And certainly almost every client conversation I had this year really did revolve around tariffs, which ones were likely to be enforced, how the outlook would proceed from here. And I think, unfortunately, the message for 2026 is that uncertainty around tariff policies remains. It may be a little less volatile than what we saw in 2025, but we do expect not only tariffs, but also export controls and other sorts of sort of trade restrictions and incentives to continue to be introduced by various countries throughout the year. We could see new trade deals as well. So I think, in terms of sort of how CEOs need to plan for these things, I do think we'll see continued volatility around specific product rates, as you were just mentioning, as well as rates for specific countries as well.
And so how do executives then, I guess they've had some practice this year, they've gotten some practice, but how do they go about tackling that when it is so volatile?
Yeah, absolutely. And yeah, thankfully they have sort of built up those muscles this year, so they will certainly need to continue to exercise them in 2026. What we've seen is not only in terms of tariffs, but also, other types of geopolitical risks that are sort of unpredictable in the current environment. We're seeing a lot more companies turn to tools like scenario planning. 66% of the 66% of the companies that are best at managing geopolitical risk use scenarios to set their strategy and to test their strategy. So I think that will continue to be a key tool in the toolkit going forward.
And I think one of the other things you highlight that's really interesting that's sort of related to tariffs, because tariffs have been used as a tool in this way, is scarcity of various resources, whether those resources are critical minerals, which have been at the center of some of the tariff and trade back and forth, or talking about things like water as well, which has become, it's not only vital for life, but also has become important for things like data centers and cooling in some cases. So how is all of that going to play out, and what do people need to pay attention to?
Yeah, absolutely. So we do see geopolitical competition for either kind of the continued control of those resources or for greater access to those resources really being a key story in 2026, and will drive a lot of the policies from governments, as well as a lot of the implications for companies, both in terms of risks as well as opportunities to expand in certain areas. So certainly freshwater, you mentioned critical minerals. Both of those are really key to data centers, to electricity production. So those are two really critical types of resources that we see governments that will really sort of ramp up their competition in that area. And we could see some sort of going it alone, others trying to reach out to allies and partners to really build those critical supply chains.
Now here in the U.S., Courtney, looking at another one of the things that you're watching, here in the U.S. rates are trending lower, but we've not necessarily seen rates in the market trend lower. And what is happening with the sort of borrowing cost atmosphere and environment around the globe, and what should we be watching for in 2026 there?
Yeah, absolutely. This is another one of those scarce resources broadly defined that we point to in terms of capital. So what we're seeing is a lot of geopolitical competition around access to capital and the growing politicization of capital allocation within different economies around the world. So we think this will really continue to reshape or refine the global financial system. So, there's, sovereign debt issuance is at an all-time high. Debt servicing costs do continue to grow, though. And so we could see some fiscal pressures in certain countries. And how this sort of plays out in terms of the private sector's access to capital and the cost of capital, I think remains to be seen, but bears watching closely as the year progresses.
Courtney, as you know, AI has been like the theme of this year. What are you watching with reference from your perspective? What's important about AI next year?
Yeah, absolutely. I think the buzzword this year has certainly been sovereign AI, and I expect that to continue next year. So we are seeing governments around the world really trying to accelerate the development of AI value chains and algorithms within their own economies, because that is seen as critical to economic security and national security going forward. So we'll see governments really focus across the AI value chain. It's not just about those algorithms, it's also about the critical minerals that go into the semiconductors that power the data centers. And of course, data itself is a critical resource as well.
What about geopolitical conflict and when that spills over into economics? So obviously, we have a number of different flashpoints to watch, whether it be Russia, Ukraine, even in Southeast Asia right now, what's going on, China, Taiwan. There's a long list, Courtney. What do you think is most urgent potentially next year to watch?
Yeah, you're right. It is a long list, so it is sometimes hard for executives to try to keep a handle on everything. I think one of the main messages is that the list will remain long. So we have seen the number of conflicts increase in recent years. This decade is on pace to have more wars than any decade in more than 40 years. So that's the unfortunate reality. I think in terms of going forward, certainly the war in Ukraine will continue to be a focus, both in terms of what's happening on the battlefield, as well as what's happening in various negotiations around ending that war. We could see continued uncertainty and instability in the Middle East, perhaps. And then, as you mentioned, in various parts of kind of Southeast Asia and Africa as well.
A long list, a sadly long list. Courtney, thank you so much. Really appreciate it.
Thank you.
Much more markets action is coming up. You're watching Market Catalysts. Now time for some of today's trending tickers. We are watching home builders, Juventus, and Teradyne. First up, home builders. Watching the sector as new data shows that home builder sentiment hit an 8-month high in December. The National Association of Home Builders data showed the index hit 39, but it's still below the 50 break-even level for a 20th straight month. Activity remains constrained by rising construction costs because of tariffs on imports. 2/3 of builders also reported they're offering incentives to move buyers off the fence. Next, Juventus. The football team saw its shares rise by the most this year after stakeholder Exor rejected a bid for its share of the team. Crypto firm Tether Holdings made a $1.3 billion offer for Exor's 65% stake, which marked a 21% premium to where shares were trading. Some of the price action following the rejection might indicate investors don't see this as the end of the saga between Tether and Exor, but Exor did indicate publicly it's got no intention of selling. And finally, Teradyne, the stock getting a double upgrade at Goldman Sachs. The firms upgraded the stock to buy from sell. They see an AI-driven demand boost for the manufacture of chip testing equipment. They also lifted the price target on the stock to $230 from $148. Coming up, Rivian unveiling a custom self-driving chip as it makes a push into AI. We'll hear from the CEO next on Market Catalysts. Rivian is looking to advance autonomous driving as it develops its own AI chip. Senior Autos reporter Prasad Subramanian sat down with Rivian's CEO to talk about why an in-house chip made the most sense for the company.
When we made the decision years and years ago to build our entire vertical software platform in-house, all of our computers in-house, and not rely on tier one suppliers for any of that content, it wasn't like we said we're going to go do that and then didn't put the work in. We then built teams of thousands of people to go put all that together, spent many hundreds of millions of dollars to develop those systems. And when we've approached autonomy and our overall AI roadmap, we had a very similar view, which is this is going to be the most important technical shift in transportation. I would say more than anything else, more than anything since the beginning of the car. And we wanted to control our own destiny. So back in 2022, when we began this process of redesigning and clean sheeting our platform, we said to do that, we want to control the perception platform. We want to build a very robust data flywheel. We want to build this around extremely high levels of inference, so very, very smart brain. And we need to make this fit into a package that is cost effective. And so to do that, one of the big drivers of cost is the inference, is the compute. And so we ultimately decide to bring that in-house. And then again, that's like, if you do that, that means you're signing up to spend just on the chip alone many hundreds of millions of dollars. You need a very large team to do it. You need to recruit a team that's incredibly capable of developing silicon. You need a partnership with TSMC or equivalent, but most likely TSMC, which in our case is our partner. And what we're going to get is better performance. It's something that's very specific to vision-based robotics. The instance here is a vehicle. You can imagine there's other instances in our business that might benefit from a inference platform for vision-based robotics. And then we needed to build this data flywheel. And so lots of offline training, that means lots of GPUs. But this is by far our biggest investment category as a company from an R&D point of view.
I heard, we hear a lot about the data center plays and people that are investing heavily in chips, and how making your own chips kind of cuts your margins in half, right? That's so powerful it could be once the investment's made. So I want to mention Tesla because they sort of are doing the same thing with regards to going fully vertical. They have their own chips. They're doing their own data centers. Do you think that, and your autonomy plays different with different sensors suite, do you think that you guys can sort of meet and surpass where they are now in the next couple of years?
I mean, of course, our goal is to be world class. Tesla, to be clear, is a great product. They built a really impressive platform. We very much are aligned with them on believing it needs to be a neural net-based approach. Building an end-to-end trained model that's using the fleet of vehicles, building a data flywheel that trains the model with reinforcement learning. So we really agree there. We do have a different view on the benefits of a diverse set of perception modalities. In our case, being still camera heavy, call it camera primary, but by including radar and LiDAR, it allows us to turn our entire fleet into a ground truth fleet. So every vehicle on the road is very helpful in training our model. So we have the view that it'll allow us to build the model very rapidly, and then those sensors, in addition to helping us build the model, really do a nice job of covering some pretty extreme corner cases. So of course, radars have the benefit of not being affected by low visibility conditions. So things like fog or rain, it does very, very well in. And LiDAR has the advantage of being able to really accurately perceive the three-dimensional world, and it can be used to train a two-dimensional image of a camera. So you can really use it to accelerate the speed at which the neural net can understand the world. And so that's been our approach, but our view is getting to level 4. So this is, I think that's the end state everyone needs to be thinking about. And this is no longer science fiction of 10 years from now, 15 years from now. This is in the fairly short horizon, next few years, we believe personally owned vehicles should be offering level 4. And it's going to change the way you think about your car. Your car suddenly, your car almost becomes does some of the things if you were to have a nanny. You could have your car go pick up the kids from school. I have 3 kids, and they're 9, 8, 7, so they're in sports, many different sports, constant practices and drop-offs. It's pure chaos trying to get everybody to the right place. And so I know in my own life it'd be very helpful to have a car that would be able to move them around to the different places and different practices and events that they're going to.
We hear 2026 maybe an inflection point there, so we'll have eyes on that. I know your time is limited, but I just want to ask you about the bigger picture of the EV industry in America. The tax rate went away in the start of Q4. How are things going for you? I know we can't talk about metrics, but how does the market look for you right now? And I've heard people talk about how the pure play EV makers might actually benefit from this because they have fewer competitors in the market. Yeah. I've heard that. Now, I'm not sure if that's true or not, but what's your sort of overall take on what's happening here in the U.S.?
I think in the long term, it doesn't materially change. It doesn't change the end state. I do think the dynamic, the system dynamics and the causality of what others are going to do is interesting to think about. It's, I think what you postulated in your question is probably somewhat right. I think you are seeing a lot of manufacturers pull back. I think that's unfortunate. I think it'd be healthier for the auto industry if everybody was focused on electrification. I think that pullback means there's going to be less choice, which is bad for customers. But I do think because there's less choice, it means it's going to be a less competitive environment. And so we can't control what others do. We can control our own business, and so the things we can do to help drive electrification adoption are make incredible products and give customers additional choices. If you were to look at the segment of vehicles with price points that start under $50,000, there's very few highly compelling choices. And as a result of that, a single company, Tesla, has accumulated around 50% market share. It moves around quarter to quarter, but call it half the market under $50,000 is one company. And that's not a reflection of a healthy industry. It's a reflection of an underserved market. And so if we want to see electrification go from its 8% of adoption, which is what it is in the United States today, to let's say 25 or 30 or ultimately 100%, we need to have more than one great choice. And I think Tesla will continue to be a great choice, but I think there needs to be others. And of course, I think Rivian is one of those with our R2. I think it's going to be exceptional. The car itself is just amazing. but I hope there's others. And we're excited to have a partnership with Volkswagen where we're helping to take some of our tech, applying it in their vehicles. I know the vehicles we're doing in partnership with them are also going to be great vehicles, so there's going to be some choices there. But I think the market's underserved with choice today.
Copper is rebounding today after a steep sell-off on Friday, but the metal's been on a record run this year due to a multitude of factors. Joining us to dig into what they are, Yahoo Finance's Ines Frey. Ines, it's funny because we've talked a lot about gold this year, we've talked a lot about silver this year, we haven't talked as much about copper.
No, and it's a huge metal that is playing a big part in the whole AI theme. Part of the reason why you saw some volatility last week with copper, because if the AI theme's unwinding, then you would see that volatility. But nevertheless, several things are happening here when it comes to this industrial metals. You're seeing some short covering today. You also are seeing some tariff concerns that have been happening as well, because some traders are concerned that copper in 2027, refined copper, could be tariffed. So there's some hoarding that's happening with this industrial metal. And of course, you've seen the US dollar that has been going lower. This has been a theme this year. But there's some structural themes when it comes to copper this year, and that is, of course, we've heard of the electrification theme, but then the AI theme. So it's not just the data centers, the chips, but it's also the entire electrical grid that adds another layer, massive layer of demand when it comes to copper. And then you've got the developing world that is using more and more of this. So going into 2026, Wall Street is expecting a deficit for 2026 of copper. Goldman is calling copper its favorite industrial metal for 2026. So you saw recently that we've seen recent highs for copper at around 11,800 per metric ton. That's in London. And also with the Fed last week announcing that they expect economic growth to be 2.3%. That's been bullish because copper is sort of a barometer of economic health, what you expect from demand. But nevertheless, AI is going to play a major theme in this industrial metal that is up about 35% year to date.
I was just quickly looking up an ETF that tracks copper miners, right? Yes. Because it's always interesting to see if the gains in the stocks match the gains in the metal, and it looks like they have, and then some.
Yeah, completely. And there's also a physical-backed ETF that Sprott has that is up about 46% year to date. So it has been a rally all around when it comes to metals, but copper is also, it's a big one. It is the second best conductor of electricity behind silver. So, and because of the price, obviously you were going to use much more copper when it comes to the grid, everything else.
Really interesting stuff. Thanks so much. Appreciate it, Ines. Coming up, ahead of Warren Buffett's retirement, some of his most pivotal decisions according to an investor. We'll be right back. Warren Buffett is set to step down as CEO of Berkshire Hathaway. He'll be handing over leadership to Greg Abel. But before that change takes effect, we want to look back at Warren Buffett's legacy and some of the ways that he changed the investing landscape. Joining me now, Lee Munson, Portfolio Wealth Advisors President and CIO and longtime Buffett watcher. So it's good to have you here, Lee.
Thank you. It's great to be here.
So I want to look at this through the lens of what you think were Buffett's sort of top three pivotal decisions. And let's take them one by one here and dwell on them for just a second here. So first of all, the sort of model that he used to build Berkshire in the first place, which was different from other investing models. Talk me through that.
So originally, Warren Buffett had a hedge fund. He started in the 50s. He shut it down in 1969, and the original structure was easy. The first 6% goes to the clients. Every profit, every dollar above 6%, he took 25% of the profits. In 1969, he shut it down. He didn't understand markets. They were too frothy. So when he started Berkshire, this was a profound change because all of a sudden, he's not looking just to make a performance fee. He's looking for permanent capital. So he didn't want to have to deal with redemptions. He didn't want to have to deal with writing letters every quarter and keeping people in or justifying his moves. He wanted somebody to think longer term, and that was a huge shift in his mindset when he got into his 40s. And every scholar of Buffett will look back and say he would have never become one of the richest men in history if not because of this permanent capital structure. So when we think about his legacy, it's not necessarily about what he bought. It's really the structure that allowed this compounding and reinvestment of all dividends. Berkshire's never never paid a dividend. It just was there just to appreciate over time.
And it's also interesting because counterintuitively, you would have thought that sticking with the hedge fund model would have brought him at least short-term profits, right? But as we saw, it built the long-term profits and legacy for the company. Let's talk about the structure. While we're talking about structures, let's talk about Geico and how it is different from other investments, particularly other insurance companies as well.
Well, it's the total engine behind Berkshire Hathaway. Now, a lot of us like the old Warren Buffett grandpa with his sweater, telling stories by the fireplace about See's Candy. And most people have heard about he bought See's Candy and he used all the cash flow from See's Candy to buy other things. Not unlike a more, what Philip Morris did during the last century of taking all the money they made from cigarettes and buying cheese companies, right? But more profoundly, it was always really about Geico. I think that we talk about the See's Candy story because it's easier to understand, but he bought Geico and then basically he made all of his policyholders investors because what he got with the float from Geico, you take money in for insurance and then what you don't pay out in claims, you can invest. Well, he was one of the greatest investors of all time, so he had a source of capital that had very, very low cost. It was liquidity that, he didn't have a liquidity problem with investors saying, hey, we need to nab this cash. So his ability to look forward into the future and know how much cash flow he was going to get made it a lot easier to take over companies and to buy things and have a schedule. Nobody had done this up until Buffett.
Well, as you say, there's this sort of like image of him as this sort of grandfatherly figure, but that's also calculated in some ways. It can be authentic and calculated at the same time, I suppose. But the way that he communicated with investors, in addition to the shareholders meeting, was through his annual shareholder letter. How did he use that as a tool?
He used it for social engineering. He wanted to engineer his client base. He wanted to make sure that he was selling long-term value. He wanted to be sure that he was the original Bitcoin tout, right? He wanted to make sure that people bought Berkshire and held it forever and never sell your Berkshire. And so not only was the structure designed that way, not only did he have permanent capital, but through his letters, he would talk about moving beyond volatility and not having to think about volatility, talking about a margin of safety. Everything he bought was, a value. He was buying dollars for 50 cents. And on top of that, he was a salesman, right? He talked about underperforming during bubbles and that compounding was really the way. And I think he convinced people that the moats were really about competition. I think that was one of his greatest magic tricks, because really what he invested in through the most part of his life were monopolies and places that didn't have competition and were not based necessarily on the innovation of America, but was based on companies like an Apple computer that just had all the cards. And I think he made people comfortable with that type of, monopolistic oligopoly inside of America.
Lee, how many of these things do you think will continue at a post-Buffett Berkshire Hathaway, right? I mean, obviously the structures, which were sort of original to Berkshire and Geico, they're already in place. But, the letter and sort of how do you think that all evolves?
Well, I think it's going to stop, right? I always look at book value versus the price. We've had times where the net asset value of Berkshire has, gone negative. Here's what the thing is. Buffett's legacy is the architecture of Berkshire Hathaway. His legacy is how he did this. Greg Abel, I'm sure, he's a brilliant guy. He knows how to operate. He's been doing it for years. This transition has been signaled. It's nothing new. Everybody on Wall Street knows. But we're not going to have the magic duo of Warren Buffett and Charlie Munger telling these stories and keeping investors focused, solid. And also, those Berkshire Hathaway shareholder meetings were also sales productions to get people to buy the products that Berkshire had bought within its holding company. So do I think that the operations and the culture will stay the same? Absolutely. But how are we going to get that next generation of disciples of Buffett who just buy that stock and never, ever sell it? That remains to be seen. I would say as an investor, I'm looking at book value. I'm looking at anything where, just like Buffett did, if the sum of the whole is selling for less, If the whole is selling for less than the sum of its parts, it could be a good buy.
Interesting. Well, we'll see how it all plays out, and I'm sure we'll check in with you again soon, Lee. Thank you.
Thank you.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance is coming up.